Okay, so a budget should align with your financial goals, okay? If you keep doing what you're doing, you'll reach your goals. What do you need to change to reach these goals? So it's about understanding a few key elements in your budget and things and how we get to that goal. One of the things that is super important is reviewing your costs and reviewing your expenses and things, okay? Power, consumables, things that do not have an add value, okay? Power is one of the big ones, right? And petrol too. As an example, the power that comes into your house is the same power from any provider, okay? There's no extra value in that power or in that petrol, or when you borrow money, there's no intrinsic extra value in that. So we should always look at the cheapest option available, okay? That is a key element. And if you review your power and all that sort of stuff regularly, you can take advantage, and it can be, and it might not seem like much. Like what we've got to look at is when budgeting, we're looking at small changes, but ultimately big cumulative changes, okay? If we can save 6 cents or 12 cents or 15 cents on fuel, okay, over a year, okay, that could be hundreds of dollars. If we can save hundreds of dollars on our insurance and on our power every year, okay, each one of those different elements compounded can be thousands of dollars back in your pocket, okay? That's money that we can spend on our children. It's money that we can put into having fun, going traveling, doing experiences, okay, or saving for the future. So the mindset is small incremental amounts add up to large amounts over time, okay? Subscriptions, this is one that I'm a little bit guilty of. Netflix, Prime, all those sorts of things, okay? Yeah, absolutely. Review those regularly. Do you use them? What you should do is swap and change. So if you get one subscription, go through the catalog and then change to the next one, okay? Look for free. One of the things is, free periods, okay? They often offer, 1 month free or 2 months free or something like that. Take advantage of those when you can, okay? Food and groceries, this is a really hot topic at the moment, okay? Groceries are an extremely expensive, fundamental thing that we have to, and we can't live without now. I would suggest that we look at things like those coupons that we get, your everyday rewards or things like that, looking at bulk buying, okay? Bulk buying is one of the ways that you can save a lot of money, particularly on things like, just menial stuff like toilet paper, paper towels, those sorts of things that you can store, okay? So places like Costco are a great way to buy in big volumes, put them in the garage or in the cupboard. They cost you about 30 or 40% less, okay? Those little incremental changes, okay, will add up at the end of the year, okay?
So Costco is actually cheap, Rebecca?
Absolutely, yeah, definitely. For bulk, yeah.
I tend to then eat more. This is my trouble.
Oh, right, yeah. Well, yeah, guilty of that. But again, it's yes, bulk buying. So those items that you can store, so like for fresh foods and stuff, it's probably a little bit harder, okay? But certainly for those items that you can chuck in the cupboard, chuck in the garage, put in under the whatever, in the drawer or whatever, definitely look at bulk buying and when you can and have the ability to. Insurance health check. So this is a big part of my business, okay? Your insurance should be reviewed. If you have any of the insurances that I deal with, or any of your insurance for that matter, you should definitely review it. About half my clients are, I do reviews for them. The amount of money that we can save clients, and it's not just about looking at the current settings and trying to find the same like for like. It's about going, what do you actually need? An example, I've dealt with a client this year, last week, beg your pardon. He's paying close to $1,800 a month on insurance, okay? It's a pretty eye-watering amount of insurance. And when I went through the plan, he sent it through to me, and I did it without him there, I was blown away at how much insurance he had. And I could immediately see that he was over-insured. I went and sat down with him and I asked him, what does this do for you? What does this do for you? He didn't even know what half of it did for him. So what the advisor had previously done is just ticked all the boxes, gone, here you go, this is what you should have, and just sold him a package. My philosophy is we should not over-insure all of my clients have what they need for their specific goals, either now or in the next couple of years, okay? And at Haven, our philosophy is that we regularly review our clients every 2 years, okay? Life changes, we have children, we have, get married, buy a home or move house, change jobs. There's all sorts of different triggers in those 2 years that may, validate a review of your insurance, okay? Sometimes we need to go up, okay, because we've increased our risk. Sometimes we can go down too because we've had a windfall or we've had some other, income of some sort that's increased, okay? So reviewing those things, and then find your tribe. And I think what we've got here is a really good network of people that, I don't know how you feel about discussing your finances, but we need to be more comfortable about sharing our situation and making sure that we collaborate and work together to go, hey, I'm a little bit struggling this week, or the last little while has been a bit tough. Have you had any success on those saving tips that Andrew told us about? Or just working together to support each other as well, and make sure that everyone feels comfortable about being vulnerable with their finances, okay? That's a key element. We need to be comfortable about our vulnerability. I mean, Christ, I'm standing up here in front of you guys. I'm feeling pretty vulnerable, so, all right? So, yeah, it's a key sort of, a few components to that. So, this is one of my little plans that I put together for people through the bank, okay? It's pretty straightforward. There's nothing terribly complex about it, but it is just giving you guys the confidence to go, oh, I can do that, okay? So, how does it work? Our income there comes in, okay? So we get paid, all right? It goes into a holding account. A holding account gives, it's just where the money gets put into, okay? And what we do is obviously I've put in the KiwiSaver there because obviously we expect that we pay into our KiwiSaver. I'll come to that in a second. One of the things we can do is put some into a savings and some into a transaction account. So what happens is your money comes in, and let's say it's, I don't know, $1,000 for the week, okay? We set up an automatic payment, okay? And we transfer $500 or whatever your outgoings for that week are, and we transport that amount into a transactional account. From that transaction account, we then have all our automatic payments go out of that account, okay? And we know that we do not touch that account, okay? So, you can label these days with banks, you can label them as a bills account or whatever you want to call it, okay? You set that up and you have all your payments coming out of that account. You then know that whatever is left in the holding account, you can either use for your personal, expenses, going out for dinner, whatever you're want to do, okay? Go to Rainbow's End, etc. The other amount, again with another automatic payment, you pay into a savings account, okay? What you do with a savings account is you then look at how and what are your objectives, okay? And what type of account or investment you want to put that money into, okay? So, short-term goals should go into a fixed interest or savings account, okay? Because we want to have access to that money. You want liquidity, and you want to be able to access that money quickly. So generally speaking, a savings account will encompass around about $2,000 to $5,000, generally speaking, okay? That's, for the most part, within most people's financial capability, or that's where we should aim to, okay? If we have an unexpected bill, the car breaks down, okay, we've got to go to the mechanics, all right? We've got to go to the doctors. We've got to do something else that is an unexpected cost. That's what that interest or savings account is for. I've put in there such as term deposits. So term deposits, I'm not personally a big fan of. I find that they have a very low rate of return, okay? They are fixed in that if you want to access the money, it's very hard to unwind your money. It takes 31 days to unwind your money out of a term deposit, okay? And if you look at them versus inflation, okay, they generally sit around what inflation is. So technically speaking, your money is going backwards, okay? What I prefer is managed funds or ETFs, entity traded funds. Does anyone know what those are, or have they heard of them before? Yep. Okay. Yep. Yeah. Yep, absolutely. So managed funds or ETFs are a collection portfolio of multiple investments, okay, that basically are just basically a diversified fund, and they have a specific risk profile attached to them, okay? Long story short, they're basically like KiwiSaver, so very, very similar to how KiwiSaver is invested. You have your income assets and you have your growth assets, okay? They have different objectives and different timeframes and things in which you would invest, and they have different risk profiles, okay? So they're made up generally of, you know, about 100 different companies, okay? That way, you have the potential, okay, for much higher returns, okay? And when I say potential, and this is a key element, you can see at the top there I've put term deposits provides assurance of return and time frame, okay? So that gives us security. We know what the outcome is. Managed funds, okay, have potential, okay? They can, in some cases, have negative returns, and that's why managed funds are focused on medium to long-term goal planning, okay? What we have to manage is obviously what your risk profile is and what your time frame is. So a managed fund with a low risk profile could be suited for someone that wants a combination of a savings account, okay, and then potential for slightly higher returns with a minimized risk profile. Do you understand that? We could then have a second fund, which is a more growth orientated or a more aggressive fund, okay, that has higher ups and downs, and I'm going to cover off what that all means in a little bit, but it means that would be our longer term plan. Okay, so we can have multiple different options to make sure that we get the overall outcome and make that picture look nice for you. Okay, any questions about that? So, key advantages, okay, the potential for higher returns, okay? As far as investments goes, they're very cost effective, okay? They don't require much thought or investment of your time, so that's a key thing. They're managed by a fund manager. You just put the money in the fund.
Take you back a bit, Mr. Hunt,
Yeah.
concerning the slide to the previous slide.
Yeah.
So you say that you advocate for the fixed, the managed funds as opposed to the fixed interest. You prefer more the managed, the second one to the first one.
It's dependent on what your specific requirements are. Generally speaking, yes, managed funds are certainly better. I can show you some data and I can show you some of the projections. Like basically, like if you look at the current interest rates on term deposits, they're about 3%. Okay, this is going to get a little bit into detail, but 3%, and then you pay tax on that. Okay, so if you take tax off, and if we use, let's say, 30%, your net return is 2%. Inflation is more than 2% at the moment. Okay, so your money is losing value, okay? Managed funds at the moment, in a relatively safe fund, can sit around 6%. And in good years, I've seen them return over 25%. Now, that's an exception. I'm not saying that that's stating that that's, but what we can see is that there is really high potential for them, okay? But it's that time frame, and I'm going to show you a little graph on the whiteboard soon around where that potential and how that sort of dynamic can be a little bit, yeah. Okay, relatively liquid. So what that means is you can access the money relatively easily. Okay, it takes about 5 to 10 days to get your money out as opposed to that 31 days for a term deposit. So if you did have an emergency, okay, and your savings fund isn't quite enough, okay, we can unravel your managed fund reasonably easily, okay? It's easily managed and monitored, okay, because they all have apps and stuff now, okay? So it's really transparent, and I think that's a really important element of your money, is being able to see it and manage it and you know, look at it and make sure what's going on is what you want and things. They are relatively low risk, okay, and it's due to diversification and the type of investment pool. So diversification is the type of spread or how much different investments there are in that fund. And like I said, there's about 100 different companies, let's say, in those different investments, okay? So what that means is if one, or let's say 10% of the fund has a drop in the market, okay, because that particular market sector has seen a slump, okay, another area of the market goes up, you might have a net collective of 2% gain, Okay, so diversification helps to manage the volatility in your investment. Okay, and you can make easy decisions based on your tolerance. Okay, so if we have someone that is less, I guess, keen to see fluctuations in their fund, and they want to just have a more stable pathway, we can choose like a balanced fund, okay, or a cash fund or something like that. Okay, someone that's like, no, I'll take the opportunity to get 12 or 15% return this year, you can go into a focused growth or a high growth fund. Okay, you take the risk that we don't achieve that, but you also have the potential to get there as well. Okay. There are some disadvantages, and like I said, transparency is a key important of this. So there is the potential for negative returns. And what that means is if you invested $10,000 today, and in 6 months' time, Donald Trump tries to close the Strait of Hormuz and the fuel prices go haywire, oh, that's actually happened, right? You can see your fund drop. And let's say if it's a 10% drop, which is quite a realistic number, your value is now $9,000. And you go, ugh. And I go, oh God. What that does is obviously makes us a little bit nervous, okay? What we've got to be mindful of, and this is one little thing, is that it's just time, okay? Funds recover, okay? And if we look at investments over the last 50 years, every decade, the fund has returned 100%, okay? Consistently, with a few drops in there, so that we've had, the 80s crash, dot-com boom, or crash. What was the other one? 2008, the GFC. Okay. COVID, and the current state of things. Okay. We've seen these drops and we've seen these different things, but you will see the funds recover over time. Okay. One of the things to keep in mind, COVID. What happened in COVID? Funds dropped by approximately 30% over the space of a few days. 30%. And this is the thing that I keep in sort of perspective. We're talking about a global shutdown. The whole world shut down. People did not leave their homes. Factories shut down. Okay? Global commerce went from 100% to zero. Okay? Or virtually, let's call it zero for argument's sake. And the funds only dropped by 30%. We didn't see them drop down to 80%. In my mind, the way that I look at it, a 30% drop on a global catastrophe is not a bad outcome. But what was a catastrophe was people pulling out of their funds when the fund went down. Okay? You know what I'm talking about, right? So what they've actually done is they've realised the loss. They've locked in the loss and missed out on the potential upside when the funds went back up. While fees are low, there is a cost. Okay, and you pay around about 1% on your fund. So if you have $10,000 in there, you pay $100 a year. Okay. There is no immediate access, which a savings account gives you access to. Okay, and really not ideal for short time frames. So if we're just trying to do a quick, get our money together for a holiday or something like that, it's not ideal for those short-term ones. Okay. So that's how those long-term goals work. KiwiSaver, shares, and property as well. Okay, so we'll talk a bit about property. I'm going to talk a little bit about commercial property as well. Has anyone got a commercial property, or is that?
It would be good to know about it.
Yeah, okay. So, as I was saying before, KiwiSaver, one of the most powerful financial tools that you are likely to have in your lifetime. It sounds a bit daunting and a bit like, oh, calm down, mate, like, geez, It seriously is. When I look at some people, and it's obviously more effective for younger people because they've got a longer time frame to build, it has the potential to be millions of dollars for some people. Okay? And that's not an exaggerated number, it's not an unrealistic number. It is truly that powerful. Okay? For the most part, like, people will probably land with around about $300,000 to $500,000 in their KiwiSaver with about 20 to 30 years to run. Okay, but managing it properly is the key element. Okay, so how does it work? As I said before, it's a diversified portfolio fund. Okay, you contribute from your wages, and this is, sorry, I didn't get a chance to update this. It's 3.5% now, 4%, 6%, 8%, or 10%. In April 2008, the minimum contribution is going to 4%. Okay, 8% in total plus the government contributions. Okay, so that's where like I was talking about the power of your KiwiSaver, you only contribute 4%, all the rest is made up of government contributions, employer contributions and returns. Okay, and that's why it's so powerful and so important for people to take advantage of. These are the different funds, okay? This is based purely on people's time scale, okay? I would never recommend a defensive or conservative fund, even for the most conservative investor, okay? We only use the defensive or conservative funds when someone's got imminent use of their KiwiSaver, such as their first home purchase, or they're retiring, okay, so when you're turning 65 and you're gaining access to your fund, and you've got a plan to use it, such as going travelling, you know, buying a new car or something like that, okay? That's what those funds there are for, okay? We use the balanced, growth and aggressive funds for people with more than 10 years to go, okay? And then we start scaling down as people get closer to retirement. So as an example, 20, 30, 40, 50-year-old should be either in a growth or aggressive fund or a blend of those funds, okay? Once we hit 60, we should start dialing back to a balanced fund, okay? So, how do the KiwiSaver investments work? We've got income, okay? And then we've got growth. Those are the two key types of investments. Income is cash, bonds, and then government bonds. Okay? Growth assets, primary, there's actually infrastructure in there as well. And growth assets is global shares. Okay? Australasian shares. And then like property portfolios. Okay? And a few other things in there as well. Okay? What they do is they pull all of that together, okay? And then in each of those different funds, so as an example, your defensive and conservative funds will have a high majority, say 90 or 100% of income assets. These provide consistent, guaranteed returns. Okay, they know what the outcome is going to be. Okay? Growth assets go up and down. Okay? And they're market influenced. Okay? When you move your different funds, so balanced sits right in the middle, growth and aggressive just have higher proportions of the growth assets. As an example, an aggressive fund will be 95% growth assets, 5% income. Okay? That's all. One of the things is that an aggressive is probably not quite the right word. It gives it a kind of a slightly negative connotation. When they say aggressive, it's just a really, really focused growth fund. Okay? The investments that make up the funds are not inherently risky. They're not investing in high-risk opportunities to provide a 50% return or a 100% return. Okay? They are invested in known quantities, known outcomes. Big companies, Microsoft, Apple, Nvidia, a whole range of big funds, BlackRock. I don't know if you guys know who BlackRock is. All those type of funds. So they're a big portion of those major growth assets. Okay? So there isn't risk necessarily. We need to sort of reframe our mind around risk. Okay? Volatility is the key word that we need to understand. Okay? So I'll try to do this as best I can. Did anyone want to take photos of that before? Okay. You guys can have ame on about this blackboard ladder, right? Or the whiteboard ladder. So let's pretend that, let's say this is 65 Okay?
That is the next stage, right?
Yeah, yeah. So this is income, okay, or defensive, sorry. The journey that this takes is a bit like a snail. Okay? It's pretty boring, pretty safe. Okay? It's a really nice, easy journey. Growth fund, on the other hand, okay. Okay. So what are these events here? This is COVID, all right? This is petrol. This is Donald Trump. This is who knows what, okay? These events affect our fund, and it's perceived in our mind that we've lost money, okay? One of the key things that I tell and teach my clients, downturns are good for us, okay? We know why? Yeah. The caveat is that we stay contributing to our fund. We must contribute to our fund. So down here, so do we know what, does anyone know what unit pricing is? Does anyone understand what that is? I'll explain it to you. So unit pricing is the price that they give a fund at any one time because of the collection of assets that make up that fund. So as an example, a growth fund, let's just say it's $1, or $3 for simple maths. Okay. So when we make our contributions from our wages, we buy into the KiwiSaver at $3 a unit. Okay, let's say we buy 10 units. It's $30. Pretty simple, right? Let's say this is $3 at the top of the market. For argument's sake, I'm going to say we've got 10,000 units. Okay? When we get to this point here, we see a drop in the market, all right? Let's say it's $1.50. Let's say we've had a major shift. Oops, $1.50. And our fund goes from whatever, how many units we've got, let's just say 10, that's $30,000. And then all of a sudden it goes to 15,000. We take a big gulp and go, oh God. Okay? What it actually means is that we've still got 10,000 units in our KiwiSaver. Okay? We've still got the same intrinsic number of value. Okay? It's just the reflected value of our KiwiSaver. So when we come up here to $5, okay, our KiwiSaver has grown. The one thing we don't want to do, and this is why an advisor is so important, is that some people bail out. They pull the parachute, okay, and they go into a conservative fund, which is hearsay, and then they flatline their returns, okay? So it's super important, and we must also be contributing, okay? That is the key element in that downturn, because that gives us an extra 50% return on our investment when the fund lands at $10 at retirement. Okay? Do you want to understand that? Yeah. Fantastic. So, I was going to do a thing. I don't have my computer and I can't do it right now, but I can do it with anyone. I can do after this once we do everything. If anyone wants to have a look at what their KiwiSaver might look like, I can do a quick little thing. We've got it on our website as well. So I've got the Haven website. So what I might do is we're going to get all your details after the meeting and things like that. And I can email everyone out the link and stuff like that, so you can do your own homework and things if you like. But really quickly, the whole point of this exercise is to show you that for the simple fund choice, okay, like someone that's sitting on, say, like a balanced fund, and we move them across to a growth fund because they now understand how a growth fund works, the journey that it's going to take, land them another 23 grand. Now, if I, some people are like, 23 grand, geez. Well, if I had $20,000 stacked on the table right now, and I said first in, first serve, we'd all be jumping at it, right? So you know, those numbers are not up to date, and that's, you know, from someone in 1970, I don't know how old people are here at the moment, but they all look pretty young, that in some cases, in some of the clients that I've spoken to in their 30s, of a household, I could probably make another $300,000 for them at retirement. That is pretty powerful in my opinion, okay? And that's not just some far off dream number, okay? That is a very, very tangible, and I think in this room here, it could be very, very likely for you guys as well, okay? Very powerful. 20, 30 years? Yep, yep. Potentially, yeah, very, very much so. Yeah, depends on what sort of fund you decide that you're comfortable with, and also the contributions that you decide to make. That's a key element as well. You know, I wish I could do it, but you know, the difference of 2% going from 4 to 6% is incredibly powerful. And if you look at it in terms of what effect it has on your daily budget or weekly budget, it's potentially not as sort of scary as you think. Okay. The other side of it too is property investment. So buying a property is pretty daunting. It's going to be one of the biggest purchases that anyone will make. Okay. Does anyone own their own property here? Yep. How was the experience of buying a property? Was it pretty good? Did you use? Yep. It's all right. Yep.
Yeah, I think because you all that when I bought my house.
Yeah.
The 2 months after buying, it crashes.
Oh, yeah.
So about 40% crash and it's still crashing.
Wow. Yeah.
So I don't have a very positive experience in terms of mortgage. Very crashing.
Okay, well, maybe do you want to sit out for this one?
Yeah.
No, I'm joking. I'm joking.
Mine was in another country, not here.
Yeah.
The location market to increase is not going down.
Sorry, could you say that again for me?
My acquisition, not in New Zealand, not
Yeah,
here,
yeah,
but because of the location,
yeah.
it doesn't go down, it increases.
Oh, really? Okay. Was that a question, sorry? Oh.
Stable.
Oh, yeah, right. Yeah, gotcha. Good. And look, and the thing is, 2 seconds. Look, property investment comes with its risks, okay? As you've identified. Like, property investment is not a you know, absolutely, you know, absolute win, okay? There are certainly risks associated with it, and that's why we need to look at, you know, proper valuations and things, how much you're mortgaging, how much you're leveraging, and things like that, what your exposure is. Make sure that you get really good advice around what your obligations are and things like that, your time frame. You know, are you looking to hold this property for 2 years, 5 years, 10 years? Okay.
Yeah, I just want to add that if you are buying property, so if you are going into any investment, I think information, knowledge is important. So before you just dabble into something, you should have enough knowledge about what you are going into.
Yeah.
So before we go into property buying, I make sure I read books, I talk to people,
Yeah.
and I look at, oh, Auckland is out of what we can afford.
Yeah.
Okay, can we go elsewhere?
Yeah.
And what is the let's say, long period?
Yep.
You don't look at the short-term period.
No.
So, sir, I would say you shouldn't look at the short-term period. You may say, oh, it's crashing, but just look at maybe in 10 years' time, in 15 Do you understand, sir? Yes, so...
No, I'm not saying it was generic. It's not limited to me. It's the economy.
Yeah.
You go in 2022, you
Yeah.
know what happened. I can understand what you say. You need a very lengthy sort of...
Due diligence.
lengthy experience,
Yeah.
lengthy consultation before you buy a house. But the thing there is this. People you meet when you want to buy, it is when they have had debt, they just want to help. If they really want to help, because it's very problematic. Pastor is there, you want to put him to go there and get, I think they have education to do.
Yeah.
And the more you wait, the more you lose. So sometimes I can understand what she's saying.
Yeah.
She's into that sector.
Yeah, I know what you're saying.
That's
Yeah.
why it doesn't work.
You might lose the
So
opportunity.
They can get
So.
information, they can manipulate information. Everything that happens, everything that happens in local government, they can know. She works there then. The other works there then.
Yeah.
They are just on the table of the papers, everything. So they can have information. For me to get information, I have to dribble around and dribble around.
Yeah, I read books. I read financial
Yeah.
books.
Yeah, I read
Yeah.
too.
Yeah, and I just don't, when you want to invest.
No, what I'm trying to say, I'm supporting what you are saying. The information is very vital, but where you get
We need to use the mic so people online can hear us.
Look,
No, I'm not trying to
No,
make
no,
that down. I'm just saying the reality. And that's who I am.
Yes.
The point is this. Where you get information is very much important, yeah? And how you manage the information you got is very much important.
Yeah.
In fact, your power base, what you have in terms of the money you want to buy, depends on what you want to buy. Houses in Auckland, today, if not because of my wife, I won't buy a house in Auckland. What she said is okay.
Yeah.
Go to Christchurch, buy property there, valuable land and everything, and manage it there. Even here, you can't get houses they build today. It's just like what do they combo? You know combo in Canada? That's what they build there, and that's what they sell the millions here. So it's just like that.
But any investment has its risks, and it's when you buy into the market. This you could replicate this for the housing market. Okay, that black line will be renting. Okay, the red line is buying a property potentially. So any investment has its inherent risks. It's just what you should do. Not to put too much of a point on it, but talk to an advisor. Okay, talk to a broker. Okay. They will help guide you, and if you say, look, I'm not from the region, what is happening in Auckland? I would talk to a few people. I would talk to, if I was looking at buying, talk to at least 3 different property agents from different companies. Okay, Ray White, maybe not Bailey's because they're high end. I won't go into that. Ray White, Harcourts, and something else, and just go, hey, look, what's currently happening in the market? What's your viewpoint? And see if that correlates, and if the information that they provide sounds similar to each other. Yeah, okay, it sounds like it's reasonably accurate. Also using a broker, which I'll explain with your mortgage structure, is absolutely vital. Okay, and I'm not saying that because we have a brokerage, okay? It's because they will give you, they should give you the right advice around how to structure your loan and things like that. Okay, so some key elements as to that. So property investment, there's 2 main property investment, sorry.
I have a question, please.
Yeah.
In terms of working a broker,
Yeah.
what advice do you give us in terms of giving instructions on what exactly to look for? Especially if you have a broker and you want them to do the work for you. So in terms of your advice, what are the kind of things that we want to tell them? You look at all these things for me. Thank you.
So when you're wanting to engage a broker, you want to know, I guess everyone's different. Okay, so are you talking about the actual process of how do I engage a broker, or what do you want to tell them, or what questions do you ask them?
Yes, the questions. I already have a broker, but in terms of, like you said, you can talk to a few agencies, but if you have a broker and you want them to do all that for you, you can.
I'd probably go online and check their reviews. I think that's a really good way of finding out if they're trustworthy. That would be my first port of call. In terms of what you need to ask them, how many loans have they done? Who do they use? Some brokers only use 1 or 2 banks. Okay, you want to make sure that they go across the entire market so that you've got access to all lenders. Okay, in terms of, the brokers should ask you all the questions. Frankly, okay, they will need to engage you and extract from you the information they need to make sure that you first have capability of borrowing. Okay, so they want to look at your financial position. The other thing too, this is a little trick for everyone. Make sure your accounts for at least 6 months prior to the loan are squeaky clean. Okay, no overdrafts, no missed payments, no. No, none of those. So you want to make sure everything's squeaky clean, your credit card's paid off, and you've got a good solid history in terms of your paying. You haven't had time off from work, okay? Because if they miss any payments, they scale down your income, okay? So those are some of the key things. I don't know if that answers your question, sorry. Yeah. So there's two main things to property investment. Residential property, okay? Commercial property, okay? Commercial property encompasses a whole range of things, retail, commercial, industrial and stuff. Property investment and the leveraging effect. Do we know what leveraging is and what equity is? Leveraging is using debt, okay, to increase our borrowing capability. Equity is the amount of capital or cash that we have in an asset. So, if we have a property worth 800,000, we've got a loan of 600,000, we potentially have an equity of $200,000 that we can leverage to purchase another property or investment. Okay? We don't actually have to have the cash, so the beauty is we don't need to have the physical cash in our account, okay? But we can use that equity, okay, that we have in that property. And this is another thing about why paying off your mortgage, and I'll talk to this again a little bit soon, paying off your mortgage by just a little bit more per fortnight or month to the tune of $50 or whatever is within your financial capability can have a remarkable effect on the principal amount that you have in terms of building equity. Okay. So I think there was, I tried to look it up, there was, if you pay off a $600,000 mortgage by more than, with $50 a week, I think it was, it'll reduce your mortgage by about 3 to 5 years from memory. That equates to about $70,000 or $80,000 in interest. Pretty staggering number, and that's just $50 a week. Okay, imagine if you put a little bit more focus on it and attention, reduce that loan down to 20 years, we're talking 6 figures in terms of interest mitigation. Okay, so that's how we look at the value of your savings. You can see there, okay, versus leveraging equity. Okay, really key element around property growth, around investment growth. So mortgage is potentially one of the biggest financial decisions you'll ever have to make. Okay. And of course, we're all going to have questions about it. How do we do it? What's best for me? Okay. I'll try to provide you a little bit of understanding around how mortgages work today. Okay, so that it's simple and that you can manage it relatively easily. Okay, so why do we have mortgages? Why do we have them? It allows us to purchase an asset that is beyond our immediate financial capability. What is required for a mortgage? So basically, you need to have an asset that the lender deems is sufficient to meet the lending requirements. Not all property is eligible for a mortgage. Okay, it needs to be certified. Okay, so you can't have an uncertified property. It has to be free, not freehold, but it has to be basically free of any encumbrance on the title, things like that. Okay. So the whole range of things. So you can't just go to any property and expect that the bank will lend you money for it. Okay, there are certain criteria for different things. Okay, a deposit or security is required. So we need to have a deposit. And again, this comes back to KiwiSaver. I know I'm hammering it on about KiwiSaver, but KiwiSaver is the potential to give you that shoe in the door. Okay. Okay. Some people, and I know with some of the younger clients that I've dealt with, because who haven't purchased their first home, after we've discussed with them and the potential for their to buy their first home with their KiwiSaver, they'll increase their contributions to 10%. Okay? Okay? And obviously that's not a long-term plan. Okay? That's about making sure that they get their foot in the door and have the ability to buy their first home. And then when they buy their first home, okay, we change down to back to 4 or 6%. Okay? So KiwiSaver can change, and it's really flexible with however you want to gear it. And then obviously you have to have the suitable income to support the repayment. So the bank has to be confident that you've got the ability to repay it. Two things to that. One is you can do it on your own, obviously, couple. Depends if there's rental income from the property. So if you intend, let's say you're a single person and you've got 3 bedrooms, you're like, well, I'm going to rent out 2 of the bedrooms at $300 a week. You get a rental appraiser to come and appraise the house and go, yep, we are confident that you can get $300 a week of those rooms. That's $600 a week, okay, which, excuse my poor mess, 32,000 a year of income that could go towards supporting your mortgage. Okay, so it doesn't have to be your work income or your occupation income that supports a loan. If there is proof that we can get income through the property, if you have an outhouse, okay, maybe you want an Airbnb part of it or something like that. Perhaps, I don't know, you want to have a student exchange set up or something like that. If you can prove the income, okay, a mortgage broker can make that work. And this is the other thing that's super important, is that income, while it might not seem tangible and easy to equate, having a broker to come and basically be your supporter, I guess. The broker will know how to sell it to the bank so that they go, okay, we can see that working, we're confident with that. Okay?
Question.
Yeah.
So, what threshold does Kiwi Saver have to get to before you can use that as, you can use that to leverage?
Technically, there is no threshold. Like, you have to leave a minimum of $1,000 in your KiwiSaver if you draw from it.
Yes.
My question would be, how much of your KiwiSaver do you need to use to purchase a property? Because if you disrupt the pathway of your KiwiSaver, let's say here, and it drops to here, you reset the journey. So it's about necessity, and it's about assessing what value does your KiwiSaver provide in terms of the security that you need to purchase a property. If it's vital, use it, 100%. Okay. If it's not, if we can use other means such as deposit or family support or something like that, I would suggest utilising that primarily over your KiwiSaver. Okay. So some key mortgage basics. Okay. A fixed term mortgage has a set time frame with an agreed interest rate. Okay. It gives you guaranteed what your interest is for that time frame. So 12, 18, 24 months, 36 months. Okay. Floating changes with immediate effect when the rates change. Okay. So that means the rates go up, rates go down, you change with it at the time of change. Okay. Whereas fixed term, obviously, it stays stable regardless of the fluctuation. Principal is the amount that you owe, okay, $600,000, and the interest is the amount that you pay for having that mortgage. Okay? I think we all know that sort of stuff, but the term is how long you have to pay back the loan. This is what I was returning to before, a 30-year loan, 25 years, whatever. In New Zealand, the longest loan that you're allowed is 30 years. Okay. Obviously, having a loan that long, you'll incur the biggest amount of interest. Okay. So on like a $600,000 or $700,000 mortgage, you'll pay about $1 million in interest over 30 years. It's phenomenal. Okay. Hence why I'm the suggestion around paying a little bit more. If your mortgage payment is, let's say, $3,500 a month, put an extra couple $100 on it, reduce that mortgage by 2 to 5 years. It's a huge amount of interest that you're not paying out that you keep in your back pocket. Okay. So basically, we made changes to these settings to basically meet your specific needs. So for some people, like for example, salary paid people, we would recommend a predominantly fixed interest. Okay, you know what you're getting every month. You want to know what you're paying every month. Okay. On the other side of it, okay, floating allows you flexibility. So we may do a portion of floating so that you can pay off parts of it quicker. Okay, you may want to make lump sum payments into that floating amount to reduce that debt. Okay, and it reduces your debt exposure. Okay, and it also helps to work with someone that's let's say self-employed. Okay, that doesn't have a continuous income. It means that they have flexibility. It means that their balance can go up and down and things like that. So mortgage structuring is really, really important, and discussing that with your broker. Okay. Any more questions about that?
Can I just ask,
Yeah.
you mentioned,
Can you use the mic, please?
just wanted to know a little bit more about commercial business.
Yes, it's right now. So, structure and leverage. Okay, so leverage is basically just utilising the property value or equity and that debt to move into another property. Okay. If we have a house, right? You may get, I don't know, what's the rent in Auckland these days? Anyone out there? Throw a number at me.
3 bedrooms, $700.
850 for 4 bedroom.
Okay. $700 a week. As the landlord, you've got to pay rates, insurance, upkeep, okay, sometimes water and things like that. There is an allowance for what's called fair wear and tear, okay, so that's an expected and a reasonable wear of the house, obviously in line with normal use. Tenants are liable for extraordinary wear and tear, okay, just so you know, and that can be taken out of your bond, right? So 700, that's 36,400 a year. Rent. Then less expenses. Rates, insurance and upkeep. 3K, 2 grand. Let's call it 1,000 for you. That's minus $6,000. Your net income $30,400 a year. Okay. On the other side of things, actually, his garage, okay? Let's say, I'll use the same amount for argument's sake. We're a really reasonable landlord, okay? $700 a week. The tenant pays all costs. Okay?
We don't understand. What's the difference?
You keep the 36,400. Okay? So the tenant must pay the costs. The landlord must pay the costs. Okay? Also with a commercial property, you have a lease in place. Okay? A lease is a guarantee of tenancy. Okay? You can lease from anywhere from sort of 1 to 20 years or so, but 1 to 10 years. That means that the tenant is committed and potentially, okay, if they decide to leave prior to that, they're legally bound to pay you until they've paid out that lease. Okay? So it gives you a continuity of income. The only catch with commercial property is obviously the values and things. Okay? They're potentially a little bit beyond one person's capability. Okay? So I was thinking about this, and one of the things we used to do is called syndication. Syndication is where you get a collection of people, whether it's 2 or more, however many, and you buy into a company that holds the property. Okay? What that does is it gives each individual a shareholding. Okay? So if I go ABC Holding Limited. Okay? You would have however many people want to buy into the company. You'd have let's say a 25, this is 4 people, you'd have 25% share in that business. You'd only have to commit 25% in terms of the deposit. So if the deposit was $100,000 to buy that property, you're only committing $25,000 of your money to that. Okay? What it does is it helps to break down the financial obligation of an individual. Okay? That is one way to get into commercial property and make that work for you. You can do it with residential property as well. You can do it, you know, if you can do it as well. Okay? You can do it any investment. So what you want to do is a lawyer would have to set up the company and things like that. But that is one very simple way of getting into investment property, because it's not easy for one person, right? I couldn't do it on my own. Okay, so get a group of people that are all on the same boat, have a really clear mandate and understanding of what they want to achieve with their property. It reduces your financial input significantly and reduces your risk as well, because everyone's sharing in it. Okay, so syndication is one of the things that we used to do when I was a commercial property broker. Okay, we used to get these properties that were represented fantastic value. Okay, and it meant that we could, you know, market to a wider group of people. Okay. How do you work out property values? So, pretty straightforward. So I'm really getting into a little bit more technical stuff here, but I think it is important for you guys to understand. Yeah. What you work out is basically what's called a rate of return. Okay? A pretty safe rate of return is 7% return. Okay? So that means that based on that range, it equals about the purchase value of $520,000 at 7% return. Okay? Everyone understand that? Any questions about it? So you just take that, divide it by 7%, that gives you that value. Okay? So if you ever, you know, let's say you do this and you're looking at purchasing a property, that sounds a very simple way of working out what the value of the property should be. This rate of return is based on multiple different market factors. What is the type of the investment? Is it a really high quality blue chip investment? Okay, your property rate of return is probably going to be about 5.5% to 6%. Okay, because it's more valuable, it's more sought after, and those sorts of things. What happens is every year, or it depends what your lease states, but your property should go up in value because of the rent goes up. Okay, so you get rent reviews. Okay, very much like you do with a property here. The point that I'm trying to get to here is that houses, the general rate of return is below 5%. Okay? Okay? You've also got all the headaches of managing all the expenses and costs of the business. Okay? Commercial property is much cleaner. Okay? The lease states exactly what the rules are, what the make good clauses, okay? What the rent reviews are, whether it's yearly or bi-yearly, is it market review or CPI, okay? So these are all the different things and mechanisms that you can do and to provide clarity around an investment. Okay? And that's why commercial property is much cleaner, much more straightforward, and I think when you're transacting with a property, like a commercial property, it's more business orientated. Okay? This is far more emotional. Okay, you've got family in there. You know, if someone's being if the tenant is not living up to their expectations, it's very, very hard to get rid of them. Okay, so tenants have a lot of rights these days. And as a property investor and owner, you need to have the ability to control who's in your property and how they look after it. Okay, so that's pretty sort of very, very generic kind of and quick overview of that. Okay. Any questions about that? Was there anything we just went over their head, or need to explain?
What would you say are the risks of commercial properties?
What's that? Sorry.
What are the risks of commercial?
If the tenant goes under, okay. If the tenant folds and he can't pay his rent, he goes out of business, okay. Then you obviously lose your income. I guess what you've got to look at is what is the actual physical property, what are the attributes of that property, what is the leasability of the can you lease it out again to someone else? This is why syndication is really important. It gives you a bigger pot to potentially build from, and you can actually buy a bigger property that has more diverse capability within it. So it might have 3 tenancies. So that way if one of the tenants goes under, you've still got 2 out of 3. So So that's why syndication is really important, because it just gives you the ability to build a bigger portfolio. Okay. So, yes, happy to talk about that more with anyone more directly if you're interested.
And you said the syndication we can also use this for proper first home buyers.
Yep.
For the personal loans, residential.
You can do it for a residential property, not your first home probably. That would be, well, you could. I guess what you'd have to look at is if you had other people buying in, okay, what are their expectations from the property in terms of rent? So you'd be paying a mortgage plus some, you know, you'd be paying them the mortgage amount if you like, or paying them a rent, or paying them an income for their input. You understand what I mean? Okay. So if there's, let's say there's Andrew, Ame, and John. Let's say I'm the tenant / owner. There's going to be a mortgage, okay, to the bank. But what do these guys expect for their input? They're going to expect an income. Okay? So you've got to weigh up. If I was a first home buyer and I had these guys come in as co-borrowers, what am I expected to pay them? You know, is that within your budget and all sorts of stuff? Okay. So basically what happens is they become the mortgage, a part mortgager. So you've got a bank mortgage, and then you've got individual mortgage. Okay?
But you as the tenant, are you not supposed to pay $700 a month proper value of the rent?
So you'd be paying a mortgage, but you'd be paying, so like if your mortgage amount is $300 per week, okay, to pay, let's say it's $300,000, if Ami and John have put $150K in each, I'd have to pay them $150 per week. Sorry. It's $600 a week. Okay? You understand? Bank, Ami, John. Okay? Because they want a return on their investment.
So I guess the thing is, you have to, if you're going for syndication, everybody has to have the same interest. If all of you are going to be rent owners, then it makes it simple.
Sure.
If somebody is the owner,
Yeah.
that means he wants profit on the investment. So
Correct.
it kind of complicates things.
Yeah, a little bit. I guess what you want to do is go in with a very clear, so you can go and get your lawyer to draw up like a mandate.
Yes.
Okay? So it outlines what everyone's expectations and intentions are for that property. Okay?
Children, right? If your children are working.
Oh, yeah, if they're adult children, yeah, for sure. Yeah, you go in as a group, yep. Because the thing is, there's tax advantages, right? Because you're running an entity.
Yeah.
Okay? So that comes down to a conversation with an accountant and a lawyer. So we have gone a little bit down a rabbit hole here. So, but what I guess the point is that if there was something that you were of interest in, we can talk on a more personal basis and talk about how we would set that up. Okay? I've done it before, done it for 7 years. So, more than
Because to me, as a church, then it's easy for two brothers or two sisters to say, okay, we want to buy property.
that's exactly why I brought it up. I thought you guys are all networking and collective together. You all understand each other, you know each other extremely well, I imagine. It's a good environment for people to work together and collaborate and grow each other's wealth. Okay. So, what happens if it all goes sideways? Okay? You go to the doctor because you're having trouble breathing. Okay? You get a pain down your left arm and your face starts drooping. Okay? Now this conversation can be a little bit challenging. We're talking about some pretty tough health stuff, but it is vitally important that we talk about this stuff. Okay? So does anyone have any concerns about talking about medical stuff? Good. So, what is the most important asset that someone has?
It's life.
Your life.
Correct. It is also your ability to earn an income. It's not a car, it's not a house, it's not the TV on your wall, okay? Your ability to earn an income in your life is your single biggest asset, okay? Because everything underneath that income is gone without an income, okay? So that's why insurance is vitally important to making sure that, we can do all the financial planning, and we can do all of the, all the right stuff in terms of setting ourselves on the right pathway, but if we're disrupted by a health event, okay, none of that makes sense. None of it works, okay? So insurance is a really key element, okay? Everyone's risk is different too. Every single person in this room has a different, what we call a risk profile, okay? We've got different assets, different needs. Children, 3, 2, 1 children, okay? Grandparents that we might want to, have to look after or whatever. There's all sorts of different dynamics that makes up a person's risk profile. So, what are the types of insurance that we cover? Life insurance, trauma, disability, total disability, medical, and specific injury. Okay? There are a few that fit in between each of those different covers, okay, that we use to protect and bolster your different requirements and things like that. But for the most part, those are the key elements. So what does life insurance do? It pays out in the event of your passing or diagnosed with a terminal illness. Okay, so you go to the doctor, sorry mate, things aren't looking too sharp, get your affairs in order, get paid out your life cover. Okay? We use that to protect your loved ones from the burden of debts. Okay, for the most part, for most people, it's their mortgage. Okay, that's going to be your biggest financial obligation. For the most part, people want to alleviate that debt for their family so that they can either stay in the asset or the house that they've worked hard for. We add additional life cover amount for income support. Okay, because just because you've paid off the debt doesn't mean that your bills have stopped. Okay, rates, insurance, food, all the other things that make up our lifestyle, car payments, fuel, there's about 100 things, right? So, debt, income, and then inheritance for our children, okay? If you want your children to, let's say, go to university or something like that, or provide access to their first home, okay? Leaving behind an endowment for them, okay? Let's say your child was 10 years old when you passed away, you could put that, let's say $50,000 into an endowment fund, which would be an investment fund. Let's say they're entitled to that at 21, that's 11 years of growth and investment, could look probably around about 80 grand, okay? Based on very simple sort of investment maths. That is pretty powerful for your children, okay? So those are the three main things that we do for life cover. There are other reasons. Some people would like to leave money to a charity. So as an example, you could leave $10,000 to your church or something if you passed away. Those are the different things that people look at, things like that. Trauma cover, okay, or critical illness, pays out a lump sum in the event that you are diagnosed with a covered illness such as cancer, heart attack or stroke. In a trauma policy there are about 50 medical conditions that are covered. Okay, I'm not going to go through them all today, okay, but the key ones, cancer is number one. For men it's about 48% of men will claim for cancer. For women it's close to 75% of trauma claims are cancer. Okay? It pays out a lump sum, so what it means is X amount, let's say it's $100,000, pays out to your account upon diagnosis, you can spend that money however you wish. Okay? Alleviates that financial pressure, okay, while you're dealing with a health condition. It's not expected, and the condition of the cover is not that you were going to pass away or anything like that, it's a survivable condition. It allows you to take time away from work, okay? It also allows your partner to take time away from work too. Okay, that's one of the main things, and I really bring that to my client's attention. It's not just about you; it's making sure that your partner, children, right? Okay, you imagine the effect of having your wife to have to go to work to keep paying your bills while you're sitting at home trying to look after the kids and trying to recover from a major health event. Okay, and then any unexpected health costs as well. Okay, so you can use it for whatever you want. Okay. And I guess, like I was saying before, if you've got an objective with your financial goals and things, you can continue to pay towards your KiwiSaver, continue to put into your savings and things like that. because that continuity is a vital component of your financial success, so you can do that as well. Disability insurance provides a monthly amount to provide continuity if you suffer an injury or illness, okay? So this is probably the most effective insurance that we have. It's got the broadest terms, and what that means is it's covered for the most amount of conditions, okay? Trauma cover covers specific types of health events, okay? Disability is any injury or any illness that stops you from working for longer than your wait period, okay? So what it does is provides a continuous income stream, so it just helps to make sure that you pay your bills and things like that, okay? Covers a wide range of health issues like it is said, okay? And you can scale the cover to suit your budget and risk, okay? So the three things that you can control with disability cover is the amount that you're covered for, okay? So it could be anywhere from $1,000 a month up to however much you earn. That depends on your income. You can change the wait period. So if you injured yourself today, you've got a wait period of 4 weeks, 8 weeks, or 13 weeks, okay? The shorter the wait period, the more expensive. The longer the wait, the less expensive, okay? And then you've got the amount of time that you're covered for. So you can be covered for 2 years, 5 years, or until you're 65. And we look at that different structure and wait periods to figure out what is your risk tolerance. So for some clients, for example, they'll have a 13-week wait period, but covered until they're 65, because their concern is if they have a more serious event that stops them from working for, until they're 65, that's their primary concern. If we've got someone that's like, no, I just need to get myself covered and make sure that I've got my window covered for, up front, and we will make an alternative plan after that, after 2 years, we'll do a 4-week and 2-year period. Okay? So that's where we'll consult and sort of figure out what works for you. This is a slightly more niche cover, total and permanent disability. So this is more for when you're in quite a specific kind of occupation that is difficult to realign. Okay, so like a doctor or an engineer or something that you're trained for. It basically means that if you suffer an injury or illness, we have a permanent injury, you cannot recover from it. Okay, they'll pay out a lump sum. In my opinion, a TBD event has more effect on you than a life event. My theory is that if you pass away, your obligations stop there. Okay, you're no longer a liability per se. If you're a TBD, you're still alive, you're incapable of earning an income, but you still need to be fed, clothed, housed, transported, and all those different things. So you're an ongoing cost and liability, and your partner probably have to try and look after you, or you have to pay for someone to look after you. So it's quite a in terms of the severity, it sits at probably the highest. Okay.
And what of ACC? Doesn't ACC cover?
Certain things, if it's an accident, that covers if it's a health condition. If you got late stage 3 cancer and they have to remove part of your organs and your or if you have a major head injury, paralysis, lose a limb, lose an arm or a leg, okay. ACC doesn't cover all of those. Okay? Yeah. So I guess I don't want to say the ideal scenario because it's not quite right, but if you did have an event where ACC does cover you, you get both. Okay. And then medical cover. Medical cover has been one of the biggest products that people have taken up in the last couple of years. Okay? It's phenomenal in terms of the growth of medical cover. Obviously, the concern is that the public health system is not currently up to scratch in terms of turnaround times. Okay, I heard a story about a guy that had a heart attack. It took 6 months to see a cardiologist through the public system. That is the difference between you living and dying. Like it's pretty black and white, right? That's as stark as it gets. Okay, if you have private medical cover, you'll get seen within 2 weeks. You'll be on the table within about 6 weeks. And you'll be recovering before they even put your name in the system, in the public system. So medical cover provides you access to private facilities, okay, so much better environment to recover, okay. The other bit is that it gives you access to non-pharmac or non-subsidised drug treatments. So pharmac is a division of the government that subsidises drugs for the public health system, okay. There is a limitation on those drugs and not everything is covered. Some of our providers will do specific like genetic testing to make sure that the drug is appropriate and best suited to treat your ailment. Okay, and it gives you access to drugs that are not available in any other like through New Zealand. Okay, so you can access overseas drugs and things like that, provided that's MedSafe approved. Okay, so it gives you the ability to get treated and seek diagnosis as well, much quicker. This is the effect that your income or loss of income has over those different time periods. Okay, so when we look at it on an annual basis, and that's gross income, yeah, $60,000 over 5, that's 300 grand that you are without. It's only for a 5-year window. You're looking at over 25 years. If you can't work for the rest of your life, $1.5 million that you're missing out on. I don't know about you, but for me, that's pretty staggering.
So you know 60,000 by a long time is a lot of money.
That's exactly the point. Like $60,000 in today's economy is not a huge amount of money, but over a lifetime, it's a considerable amount. Okay, so that's the effect that it has on your ability to be financially successful, and that's why having an insurance that provides that continuity at least gives you the chance of landing somewhere near where you want to and where you intend to. Okay. So, some concerns, and insurance is one of those sort of products that are not. It can be a little bit intangible because it's not something that sits on your table, doesn't. So the TV on your wall, okay? It sits in the background as a shield. Okay? It's an invisible shield, I guess. Concerns are I can't afford it. Insurance is sometimes pretty expensive. Okay. What I like to, my own philosophy is having something that's better than nothing, and making sure that the client has within their budget. So first and foremost is figuring out what your budget is, and figuring out can you spend $20, $50, or $100 a week. Okay, and we can do some insurance, and I've done some insurance plans for some that are like $10 a week. Okay, we find the affordability level for you. Okay, so affordability is a small concern, but we work around that. How do I know what I need? Oh, big one. Yeah.
It's not may sound funny. Please, what are the tangible benefits of paying insurance? Because when you pay insurance, maybe you pay insurance to the age of 75 and nothing happens to you. All those accumulation of money, where does it go? I always ask that. In Nigeria. It's funny because in Nigeria, I know if I'm paying insurance, maybe after 65 years, something is coming back to me.
Yeah.
But here, you just keep paying insurance, then keep paying all your money gone, and what am I going to do?
When you know that.
Well, I don't get it all. Okay. All right. Look, the insurers don't have products in New Zealand now where you get an endowment. Okay. What you are paying for is access to that cover when you need it. So yes, it is. I guess in that particular scenario, it is the money. Okay. But if something does happen, they are right behind you. And I'm dealing with a claim at the moment for a young guy. I won't get the details, but he sent me some text the other day. He goes, I cannot thank you enough. And he's got 2 young kids. So, yeah. How do you know what you did?
On that note again,
Yeah.
some of these, especially all these trauma,
Yeah.
especially where they have, how do you even know? Because some of that here just allow you to walk while you can still claim more. So how do you know that even though you are walking, but you are due for some of these payments? So I don't know if you understand what I'm trying to ask.
Yeah, how do you claim?
How do you have those insurances, those cover, trauma, whatever you call them, and then you're working, you have some of those problems, but you are still able to work. So how do you know that you ought to be claiming rather than?
So the different cover work differently. So as an example, trauma doesn't have the specification that you can't work. Okay, so the specific wording states that if you, let's say for cancer and trauma, if you're diagnosed with a malignant cancer condition, it pays you the money. It could be melanoma that gets cut off your arm. Okay, I think cut out of my forehead earlier this year. It doesn't mean that I was off work. I went to work the very same day. Okay, so it just pays out and gives you the ability to do what you want with it. Okay, so it doesn't. Like different covers have different stipulations around. Like example, the life cover. You get diagnosed with a terminal illness, but you're like, well, I'm not in good shape, but I can still work. There is no specific requirement around that in that condition. Disability, on the other hand, is specific around you cannot work beyond that wait period. So if you have a 4-week wait period and you're off work for 4 weeks or more, then it kicks in. So it's all based on how the cover works, and that's where consultation with an advisor like myself that helps to put those scenarios and work around those scenarios and understand what your risk tolerance and risk, what your risk concerns are. That's where we build a protection plan for you. Okay. How do I know what I need? Like I just said, that's where we talk with us. We look at what your dynamics are. So do you have house renting? What is your family dynamic? What do you do for work? What are your health conditions? What are the areas of cover that you particularly need? And I guess, with you, we went through that process, and we tried to understand what Charity's situation was and tailor-make a package for them. And I guess, I don't know if you want to talk to that at all, but it's every person is different, and we will make the package to suit the individuals and whoever we're covering. So in some cases we just do one person because they're the breadwinner, if you like. Okay. In other cases we'll do the whole family and stuff. Okay. Insurance companies never pay out. Yeah, that's a pretty genuine concern. Look, insurance companies these days are pretty, obviously social media and news articles and stuff are pretty, powerful these days, and no insurance company wants bad press. Within Haven, we have a 97% payout rate on claims. Okay, 97% of claims that are made are paid out. The reason that those 3% aren't paid out, the majority of it is non-disclosure. So this is where an advisor, and look, that's a pretty staggering number. If you like, to me, that's pretty powerful, right? The point is that a broker, an agent like myself, an advisor, will make sure that you give the information correctly. So firstly, your health information, okay, which mitigates that non-disclosure element. We also make sure that you understand the cover before you put it in place. Okay, so you need to understand how your cover will work so that if you make a claim, you're not claiming on the expectation of something that it doesn't cover you for. Okay, so that's really important. Insurance companies 100% pay out if they're contractually obligated to. Okay, if it's black and white, they got to pay. Okay.
Are you going to get charged if you're moving from one insurance company to another?
No. There are no fees. There are no charges. As an advisor, we will double check that there is no, implication on you. So as an example, any new health conditions and things, we wouldn't swap you and things like that. We wouldn't change providers. So but in terms of cost to you, no. And like our advice, like what today, doesn't cost you anything. So it doesn't cost you anything for the advice up front, and it doesn't cost you along the track, and it doesn't add any cost to your premiums. Okay? So whether you went directly or not, you get the same outcome in terms of price. Okay?
Well, if there's an underlying health issue, you won't be keen to take on that point.
What's that, sorry?
If there's an underlying health issue.
Yep, no. So if you've got cover in place that has the same terms, so let's say you've got let's say your knees bugger, okay? And your cover excludes that already, and the new cover would have the same terms. There's no issue with changing if it's a better price and better policy. Okay. And then I don't know what if I have as the best policy or price. So we at Haven use the entire market. We're one of the unique providers that go across the entire market. Okay. Only a handful of providers do that. It means that when we do our consultation, you actually get full clarity and you get full transparency about what the market is out there and what you've got available to you. Okay, so we make it really clear and really transparent, make sure that you've got all the right information to be able to make those decisions and things. Okay, and it's all backed up with a document that provides our recommendation and things like that. Yeah. So good advice is personalised. Okay, like I've just spoken about. We review it every 2 years. As a non-aligned advisor, okay, so like I was talking about, we go across the entire market, okay? Some advisors just use one provider, which doesn't give you the best outcome. And then it's affordable long term as well, okay? So we look to the future and what your capability is in the future. So, quick recap. Know your numbers, okay? Understand your net worth, your debt, outstanding debt, your income and expenses, that's first and foremost. Review your budget. Have a really clear mindset, what you want to achieve, what are you trying to do, okay? Align your budget with your goals. Okay? What do I need to save? How much do I need to save in order to put some savings aside, okay? Improve your debt, so obviously like I just talked about, try and clear the credit card and the car loan and various things, okay? And be smarter with your mortgage, okay? If you have a mortgage or you're going to talk to get a mortgage, talk to your bank, involve a broker. Invest your money in KiwiSaver and potentially profit savings fund, okay, or an investment such as managed funds, and then protect yourself so that your journey, okay, in life is protected and you've got that financial continuity, all right? I'll skip that one. So basically from here, if you're interested in engaging with me, before we do that, I'm going to need to record everyone's name. So under the FMA, when we give advice and anything, we need to collect everyone's name. All I need is your name, the date that we did it, which I'll collect on the thing, your name, email, and phone number, okay? If you wanted to connect with me and get some more information or do a personal discussion around your KiwiSaver or insurance, okay? Just put a yes next to your name or a Y, and if you don't, and there's no obligation at all today, just put it in, okay? Really simple. Everyone clear on that? Yep. So we'll get them to email me as well, and then they've got some questions. Cool. Right. Well, let's go with some questions then.
Yeah. The first question says, how does auction sales work for home buying? That's the first one.
So options. So, sorry.
And the second question is, please, in the current market, what income to loan multiplier are banks using for the first loan scheme?
Okay, yep, cool. So how auctions work. So auctions obviously give transparency in purchase price. So everyone is open to the floor of what the value of the property is going to sell for. So that's the first point. What you need to do to purchase that property is get pre-approval, okay? So you'll need to go to your broker or the bank, whatever you want to do, get pre-approval and tell them that you're looking at a property that's going to auction. They will evaluate your income and assets and determine what your borrowing capacity is, okay? Based on that, they will determine that you can go up to 800,000, 700,000 or whatever it is, okay? If you go beyond that, watch out, okay? Don't scratch your nose at the wrong time or something like that, right? Yep. So that's how auctions work, and that's how you prepare for an auction. I hope I've answered their question. In terms of borrowing, loan to borrowing, banks, generally speaking, are 80%, 20%. So you need to provide at least 20% equity, okay, or 20% cash or something like that. So if you've got an investment or you can liquidate anything into cash, it needs to be at least 20%. Now, in some cases, they will do what's called low equity loans. Low equity is anything less than 20%. So up to about 10% is the maximum that they'll go. So that means you only need to upfront up 10% of the purchase price, okay? You will pay what's called a low equity margin on your borrowing though. So your interest rate, let's say, is 4%, okay, normally. A low equity margin will increase that by about 0.5% or up to 1%. So that means you'll pay a higher amount of interest for that low equity. Your objective then is to try and pay off as much of that debt, because once you go over that 20% threshold, you'll then come off that low equity margin and pay the standard rate. Okay? So I hope I've answered their question.
So when you go for a low margin, below the 20%,
yes,
you're able to pay the principal. Are you looking at the principal amount?
Yeah.
The principal.
Correct.
Okay.
Yes. So if you yes, that's correct. So if let's say over a couple of years you've managed to pay off that 10% difference between the 10 and 20%, once you get over that 20% threshold, you then become a non-low equity loan. Okay. Any other questions? Yeah. Sorry.
Do you provide this? Sorry.
You go.
Do you provide discounts?
No.
You don't provide discounts
No.
for maybe your client, first time?
No, I don't, because I think the value that I add to my clients is far more beneficial than the discount that they might get. I also value myself. No, but yeah. I do value myself, and I value that the advice that I provide, okay, and the outcomes that I provide my clients is far more valuable than 10% that they get off. I had a client that we discovered through the process that because of his multi-tribal connections, would have got a 20% discount by using the provider that I'd recommended. He ended up sticking with me because he understood the value of what we provided. Okay.
Because most financial investors, they always advertise and they always we give you so amount of discount when you come to us.
If someone is advertising and promoting their business based on a discount, I wouldn't use them. Like, seriously, because if that is their way of obtaining business, that is an underhanded way of obtaining business. And that probably their advice will be discounted as well. Okay? So, look, I've become if I can be honest, a pretty good advisor in the space of 2 years. In terms of my manager and things who I work with, she's pretty, I guess, ecstatic that I've come on board. And I'm not trying to blow my own trumpet here, but I'm confident in what I do. And I believe that the value that I add is far more valuable than, saving $7 or $8 a week.
Thank you.
Okay. At the back there, ma'am, you had a question?
Yeah, I wanted to ask about commercial property investment. How do you get into it? Do you have any
How do you get into it?
Any ideas? Considering the fact that a lot of people are doing work from home, shops are moving into selling from their houses and stuff, is it still beneficial? Is it still profitable?
Yeah, so biggest, first and foremost thing is due diligence, doing your research, okay? Looking at the market, talking to a property, an agent around what's currently happening in the commercial market. What is the commercial property that aligns with you? Do you want retail? Do you want a commercial property? Do you want a multi-tenancy? Do you want an industrial property? It all depends on what sort of flavour you want in terms of your portfolio, okay? Because I imagine, you build one, do one, you want to do multiple ones. So there's a few things to sort of unravel there. In terms of actually stepping forward, you need to talk to a commercial lender. Okay, so you need to make sure that what is your borrowing capacity? Do you have the equity or money to start that process? Okay, and understanding obviously the costs. So what is what is the interest rates, and what is the return on investment that you're going to get? Because if your interest outweighs your rate of return, you're going to it's going to be negatively geared. Okay, so understanding all those sorts of things. So first and foremost, do a bit of research, figure out what's out in the market, see what floats your boat. So you go on like Trade.me, okay, just type in, go into the commercial property section, have a look, see what areas interest you, okay, and then decide if you want to go retail, Because there's all sorts of different things, right, that affect it. So like as just retail is very susceptible to market changes and things like that, okay? Whereas commercial and industrial are pretty much more stable because they're big, sort of industry and things like that. So it all depends on what sort of property interests you. Talk to a property broker, okay? I'd talk to one or two at least, okay? What's happening out there, what sort of properties are available, get some information from them, what do the leases look like, be familiar with leases, read through a couple of lease documents and things like that, and just become familiar with how they work. Are they a gross lease, net lease, all sorts of different things. So just talk to people and be really upfront with them and say, hey, look, I'm new and I'm interested in the market, but I don't know what I'm doing. Can you help me? And I think any reasonable broker or agent will give you an hour of their time to give you some pointers and things. Or contact me, of course. Anything else?
In terms of the current market,
Yeah.
how will you advise, or what would you advise me for people like us in terms of what do we need to do? Thinking, I say, okay, if let's say the average salary in the house, let's say it's 80,000, 90,000, 100,000. So what do you advise people as a community? Do we team up? So what do we do? What do we do in terms of how do we leg it into the market? And then in terms of what's available for us to buy, is it going to be the unit? Is it going to be the townhouse? Because we just want to make it practical, at least get into it. And that's one aspect of the question. And the other aspect of the question is, do we have to live in our own house if we buy it for the first time? Or is it possible to buy, say, in Fangare or in Avera, is it Avera, or New Plymouth, or all of those things, so that at least we are in. I don't know if you understand my question. I'm just trying to see how do we make it work for us, so that we're not just hearing this and it's just going over our head.
In regards to that, do you have to live in the home that you purchase? Not necessarily. Like you can buy a property. You can buy property and rent in Auckland. So you can buy. So you can buy anywhere in the country. Okay, if you want to buy an investment property, and if you want to buy your first home, it doesn't have to be the property that you live in. Okay, so what it could be is it's a stepping stone to you purchase or becoming the home that you want to live in at some point. Okay. The only thing is with that is sometimes KiwiSaver does have the stipulation. I think it was for the first home grant though, which is now not available. So I don't have the direct answer for that. But my assumption is that because it's not the first home buyer's grant, if you use your KiwiSaver, you can use it for your first home. You don't have to live in it. But correct me if I'm wrong.
So, two things we wanted to do for us. In terms of if you are doing it in Auckland, how low can it go? I've told you our average yearly income. At least 90 or 100. It just helps. And then, if we're going to do it in Auckland, say we're buying a house, because of the location, we don't care. We don't really.
Are you talking about the people here buying a house?
I'm just trying to bring this thing home to us so that we don't build this castle in the air, make it meaningful for us. Say we're buying this house in Auckland. How low can we go for somebody who is on 90,000 or 80,000 salary a year? And then if we're going outside of club, how low do you think the market permits us to go so that it's not prohibitive?
Sorry, I forgot my crystal ball, sorry. It's a very hard question to answer because we don't control, I don't know the market, I don't control the market. There's lots of different things, and we all have different journeys around when we buy and what happened in the market and all sorts of things. So I guess what we're going to look at is what is your plan for the property that you are purchasing. Okay, so if you purchase a property and you have a 2-year time frame on it, that's where you need to be particularly careful, because if the market doesn't change in the next 2 years, you're like, well, who knows? Like, is the objective to get capital gain? Because you've got to offset the cost of your interest over that time. Okay. If you're like, no, this is a home that we're going to have for 10 years, then the change in the market is less impactful, because likely over next 10 years we will see an increase in value. Okay. I guess you just have to do your research around what your capability is. So first of all is probably obtaining your capability, your financial capability through talking with a broker. He'll assess your numbers, your crunch numbers, is there 1 or 2 of you, all that sort of stuff, and tell you like, okay, your purchasing power is 800,000, okay? Go out and you go on trade and you start looking. Okay, so that gives you your shopping list, basically. Okay? Hope that answers some of your questions.
I was thinking you go like in Auckland, you can still see property for 400,000, 450,000.
Oh, can you?
No, just asking.
Let's all buy them.
I'm thinking of townhouses, units.
Yeah. So, okay, like if you so you're talking about like apartments and stuff like that?
Yeah.
Okay, so apartments have limited scale for capital gains. Okay? Because they're unit titled and they're quite complex. You'll have, what's that? Yeah, so they're unit titled. You're not technically an owner. You've got body corporate. Okay, so you've got maintenance costs that you have to pay every year or every month. So that's on top of your other costs and stuff like that. So apartments are typically a lifestyle choice because people want to live in the city, work in the city, and have that flexibility with low maintenance and things like that. Okay. Whereas if you go into like unit properties or like stratum and things like that, you've got neighbours and things that share the property, which complicates things. Okay, so if you've got like say big apartments that are, or like some townhouses. Okay, freehold is obviously, or fee simple. Okay, is ideal because that's just a clear title. No one's mucking around with your property. That is ideal because it's clean cut and things like that. But it all depends on your objectives, and getting a foothold, okay, is always a good start. Starting somewhere, okay, just making sure it's not beyond your means. Okay, that is the key sort of thing, right? So that's where budgeting and all that sort of stuff is really important to make sure that we, because you weigh up, you go, well, is it actually better just stay renting and maybe making some extra investment into a managed fund or some other investment vehicle, and not buy property to mitigate that susceptibility of volatility. Okay, so we don't have a drop in the market after we've just purchased the property. Okay, so there's all sorts of different angles and discussions that you need to have and understand a person's objectives and things. Yep.
So my question is, what advice will you give to some of us who are new here, who don't have access to some of this information you're passing? And as people who came in new, what advice would you give them to setting up this bright future we're talking about?
Well, I guess the only way to do it is you need to speak with someone like myself that has a bit of knowledge and know-how, to be frank. I'm not sure I quite understood the question, if I'm perfectly honest, sorry. Do you want to try again for me, just so I can get it? Yeah.
I want to make it a little bit straightforward.
Yeah.
Like in terms of the service you provide.
Yes.
And most of us are not eligible to that in terms of investing or doing some of the things you're teaching here.
Oh, like QE7?
Like having residence, some of them you have to have it before you can do some of those things.
Yes.
So what are the advice you give some of us who are new in setting up the
Right. I got you. Sorry. So I've got quite a few migrant clients, okay, from all over the world. Obviously, KiwiSaver is like you said, it's tied to residency and eligibility. If we just take KiwiSaver out of the equation, everything else still stands. Okay, everything else that we've talked about is still relevant. What we would do is potentially put in a fund that we can label KiwiSaver, okay? And that would be your future fund, okay? And then when you're eligible for KiwiSaver, say, we can just allocate those funds towards your KiwiSaver and invest that, and let's say it's 20,000, or I don't know, whatever amount, that just goes into your KiwiSaver, and then you've got a sort of a boost when you are eligible. We have to be mindful that KiwiSaver is a fund that you're not eligible to withdraw from unless it's first home or retirement. So the funds that you allocate to it in that particular scenario, you are sacrificing, okay? So that's one little caveat with that, okay? But certainly, everything else we've talked about and building your financial capability, with the exception of KiwiSaver, is still relevant to, you know, if you're a migrant or not currently resident or whatever. Okay, does that answer your question, mate?
Yes.
Cool.
Just in such a situation that my brother has spoken about,
Yes.
the syndication thing also come in.
Yes.
Okay, I'm asking in the situation which my brother has talked about, where they're dealing with a group of immigrants who are not probably qualified for the Kiwi ETC.
Yep.
Can the syndication idea come in?
Yep. Absolutely. Yes. Yep. As long as it's you compliant with the Overseas Investment Office, okay, which shouldn't be effective for something small like that. But that's probably the one caveat with you know, if you're not a resident or if you're on a work visa, is that Overseas Office investment criteria. It's on a sale and purchase agreement that you have to circle that you're compliant with it. Absolutely. If you know, we can set up a company in New Zealand easy enough, you know, and so on and so forth. So yeah, that's certainly an option to setting it up. Yeah. Anything else?
So do you give advice on franchise?
No, I don't. That is, you would want to talk to a business broker about that. So like ABC on TradeMe is one of the big ones, or if you just went to one of the big insurance companies that has a business broker component, they can tell you about franchising and how that works. Yes.
Have you done work communities? Have you done work for communities?
Have I done work for communities?
Yes.
Yep.
Okay.
So there's a group in Whangarei called Toko Toko Solutions. They're an outreach company that help support people that have been, I guess, put in prison and coming back to work. Okay. There's Samu, who heads the group, I know him through friend networks and things like that. So yeah, I've reached out to them, helped them with their KiwiSaver, given them similar stuff around financial capability, given them confidence in their financial situation, and I want to do it more. My next step, and this is actually one of my big stepping stones to the next step, is outreach to schools. I think financial literacy in young people is extraordinarily poor in New Zealand. We've got we were lucky enough to be considered a first world country, but I think our financial literacy and education programs are third world. Okay, you look at kids that come out of school and they have no concept of costs, interest costs and expenses and how to manage wealth, and KiwiSaver is still a really, really challenging product to get through to people in terms of the value of it. It comes from, I think, a really historic mindset from people from the 80s when Muldoon pulled the New Zealand Super Fund back in the day, and it's carried a legacy of fear and a bit of reluctance, I guess, to get on board with it. So yeah, I really want to get into the communities and help people and find ways to support more people and give them some advice, because I mean it's fairly easy advice to digest, right? I hope it's easy for you guys to understand. I hope I've portrayed it easily for you guys to understand. So yeah, definitely.
Thank you.
And I am looking for more opportunities as well. If anyone thinks of any other group or family, I'm more than happy to come and see family and things like that. Yeah, definitely. Anything else? Right, so just quickly on this, so at Haven every quarter we do a $5,000 travel voucher draw. If you want to get on board with that, I mean,
another $5,000 holiday, to be honest. So get yourself in there, and then also if you refer anyone as well, okay, you go into the draw. So every time you refer or provide another person for me to talk to, you'll get another entry for that $5,000 draw. So I encourage people to take advantage of that. That's the discount. Yes. Oh, thank you. Yes. So that wraps it up, people. So thank you very much for listening to me for quite a 2 hours, was it? Jeez. Okay. Thank you. So I've got a little door prize here. Okay. How many people are here? I'm going to give out these cards. They've got a little number in the bottom corner. Okay. So I'm going to get a randomizer, and we've got a little present here for you. Okay. So I'll hand these around. Do the kids, do you want to hand these around?
Another round of applause for Andrew. That was really good. So, from the number of questions that we've received today, I think as a church, we realize that we need to have more of this, because there are a lot of questions on our minds and some tips that we received today, and we thank God for the opportunity of what we've learned. And I think we need to have another session like this. And Andrew will be calling up on you maybe in the future. And I know a lot of people here will reach out to him. So I think he's handing out his business cards. And if any of you have more questions and want to talk with him more about all the topics we've discussed here today, his number is there, and it's a good opportunity.
Yeah.
Right. So, and I know our listeners online, because we got some questions online as well, they also benefited. So, Andrew, you were online today, so yeah. So.
Someone's just brought to my attention that QR code has another advisor's name, so I'll just quickly put on the screen my own QR code. Just give me 2 seconds. And the number on the thing was 24. Who's got number 24? Me. Oh, very good. How did you pick this?
Oh. Wow. Whoa, awesome. Yeah.
This is a little something for you.
Oh, okay. Thank you. Yes. And we also have something here for Andrew, just to say thank you for coming. Thank you very much. Just say thank you. Because when I called him up, and thank God for our pastors and house, they were very supportive. Yeah. Yeah. So when I called him up, because when we discussed this as a group, and when I called him up, Pastor says whatever it's going to cost, we were going to do it. And I spoke to him and said, please let me know how much it's going to cost us. And he says, no, I may forget about it. It's going to be free. Yeah. So he said it's going to be free, and we're going to offer our services. And when we called him up and we shifted the date and told him we want to do it on a holiday, he said, I'll get back to you on that. And he called me right back and said, don't worry, I'll be on board to come and do it. So we just thank God for someone like that. So without further ado, I'll call back. Sorry? Yes, so Pastor says there's item 7 outside. So don't rush out. So when we finish from here, you can just grab a bite, fill your tummy, and enjoy yourself. And hopefully, as Pastor said, with